So overall, we see REITs as attractive in the current economic environment, which is why we've seen greater interest in increasing REIT allocations from our investor base, as well as prospective clients that have recently reached out.
Hello, welcome to the REIT Report. I'm your host, Sarah Borkson-Keto. Today I'm speaking with Patrick Wilson, a portfolio manager for CenterSquare Investment Management's real estate securities group. CenterSquare is an independent REIT manager with more than $15 billion in assets under management. Patrick is with me to share some of CenterSquare's latest research into how REITs are positioned amid today's market fluctuations. Patrick, welcome to the podcast.
Thank you, Sarah, and happy to be here.
So first off, can you set the stage by describing the overall mood among commercial real estate investors today, given the topsy-turvy nature of markets?
Absolutely. It's been interesting times, and undoubtedly commercial real estate is having to deal with a higher level of uncertainty today, not dissimilar from all other asset classes currently. While there's always uncertainty in the market, so I think it's unfair to say that you ever have pure clarity, the tariff headlines have introduced a wider range of potential outcomes than we're used to seeing in our outlook. That said, the extent to which tariffs or potential tariffs are impacting asset values directly is pretty diminished across commercial real estate relative to other businesses or areas in which the economy are having to deal with the on and off again tariff news cycle. The main areas where commercial real estate has been impacted, though, would stem from really the interest rate volatility that we're seeing, interest rates being a very big determinant of real estate valuations, and in some ways marginally reduce the access to debt and equity capital is what we've seen from the interest rate volatility that's come through. It's also made timing capital offerings a bit more tenuous given the large swings we've seen in the treasury market. I'd also say we've seen added uncertainty created by changes in recent U.S. trade policy, which has served to really elongate or even defer leasing decisions for some tenants, particularly in the industrial sector across commercial real estate. It's also reduced the amount of inbound international tourism that we've seen year to date. We've seen, this since early April, but really year to date in the case of Canadian tourism coming into the country, which will likely amount to some softness in 2Q results out of the hotel sectors. Lastly, overall deal flow. I'd mention both individual property transactions as well as large merger and acquisition deals have really been reduced to a trickle over the last 5 weeks. And we expect this to continue for as long as the economic outlook and risk of potential economic slowdown remains. Essentially, many deals have been put on hold, and the market appears to be sitting on its hands currently, which to us makes intuitive sense, but it is a fact of the matter in the current situation we find ourselves in.
Great. And where would you say REITs fit into this picture? And what are some reasons investors might be looking either to initiate or increase their investment in the sector?
Yeah, within the broader range of equities across the GICS sectors, REITs currently sit in what I'd say is a pretty enviable position. At a very basic level, I think the current environment has introduced two main items to people's outlook, which the first of which would be a marginally greater chance of recession or perhaps just economic slowdown on the horizon. And then the second would be the potential for higher inflation. So with regard to REIT performance in the first item there, in terms of risk of recession, REITs screen quite well in this regard. Perhaps this wasn't so during the great financial crisis, which was a real estate-led recession, nor was it true in COVID, which had an outsized negative impact on real estate given the shutdown of many places of businesses across retail and office and lodging. But in a typical garden variety recession, which rhymes with higher unemployment and lower consumption spending, REITs tend to fare well given their long duration contractual leases that they have in place, the higher dividend income, which is creating current income, and their values being tied to underlying physical asset bases as opposed to sales growth that tend to derive their value from consumer and business spending. So I like to think of REITs as being short duration equities, if you will, whereby the higher current income or dividend income and the discounted lower multiple valuations that they have serve to shorten an investor's payback period versus something perhaps in the tech or pharmaceutical or consumer discretionary or even financial sectors where more of their intrinsic value is derived from future growth projections as opposed to current income. And then the second point with regard to REITs in times of higher inflation, it's fairly well understood that REITs, especially those property types with shorter lease durations, perform well in times of inflation. And this stems from their underlying asset appreciation that often tracks inflation, and also their ability to pass along higher pricing to tenants. This is particularly true in sectors such as lodging, multifamily, self-storage, senior housing, and single-family rentals. So overall, we see REITs as attractive in the current economic environment, which is why we've seen greater interest in increasing REIT allocations from our investor base, as well as prospective clients that have recently reached out.
Excellent. And can you talk a little bit about what you're seeing in terms of public and private real estate valuations? That's been a topic of interest for some time now. And where do you see those valuations heading?
Yeah, absolutely. Currently, REITs trade at a roughly 10% discount to their underlying net asset values, or what we would think of as the corresponding private market valuations. What we tend to see is REITs, given their greater liquidity relative to private commercial real estate, are the first to react and incorporate interest rate changes and fresh economic data. However, over the past 25 plus years, REITs have traded on average within plus or minus 1% of their net asset values across multiple economic cycles. So, as pricing between REITs and the private market diverges, this creates a tactical opportunity sometimes, and it allows sophisticated investors to take advantage of short term market price changes. While history doesn't often repeat itself, in my opinion, it does rhyme. And in the past, we've seen the public markets overreact both to the upside and the downside, but REITs over time always settling back into parity with their respective private market valuations. So looking forward, obviously no one has a perfect crystal ball, but if the prior view of moderating economic growth and higher inflation plays out that I shared, we'd expect REIT valuations to claw back their discount to private valuations, especially as the economic outlook improves and perhaps greater clarity is found on the trade policy as well as interest rate outlook.
And Patrick, do you think there are certain REIT property sectors that could take advantage of market dislocation? And do you see any potential pockets of opportunity ahead?
For sure, the most capable of creating value and adding to their earnings growth tend to fall in sectors or specific companies that currently trade at a premium to their underlying net asset values that I mentioned earlier, where really acquisitions can be funded by issuing equity at a premium. Additionally, some property sectors in the private markets are having to deal with refinancing issues at higher debt costs and diminished access to capital, which is really driving them toward seeking liquidity from the REITs in some cases. Currently, the senior housing sector, select pockets of triple net lease, and select names within the retail space would fall in this category of being able to pick up assets from potentially distressed sellers at discounted pricing. With interest rates staying higher for longer, as we've seen, this has given some REITs the opportunity to utilize their more lowly levered balance sheets, which it's important to note that REITs often run at, call it a 25 to 35% loan to value range. And this is juxtaposed against the private market leverage levels that often operate in the 60 to 65% loan to value range. So there is an advantage of having some more dry powder on the REIT balance sheets, which allows them to take advantage at times.
And Patrick, are the trends that you're seeing in the US REIT market today matching what you're seeing in global markets?
To some extent, yes, but each market tends to have its own nuances. We see similarities in monetary policy, asset valuations, and real estate fundamentals across markets like the UK, Pan Europe, as well as Australia. However, in markets like Japan and Hong Kong within our index, a different dynamic is playing out. For Japan, a different interest rate regime has unfolded over the last 2 years, where the Bank of Japan only recently started to hike rates and to a much lesser extent. And the probability is currently slightly greater for a rate hike right now going forward, as opposed to a rate cut, which we're seeing here in the US and in the other UK and Europe markets that I mentioned. And in Hong Kong, we've seen the economy and the underlying real estate fundamentals ebb and flow more with the economic performance of China, which is pretty intuitive. But China post COVID has really performed differently than the rest of the globe. That has created Hong Kong, or put Hong Kong in a position where they've maybe not trended in the same fundamental levels as the rest of the globe.
And given everything that's going on right now, has CenterSquare considered making any changes to its sector allocations?
As an active manager, we're always making adjustments to our portfolio allocations. And as we incorporate new market information, that's something that we're constantly on the lookout for. We've just made it through roughly 90% of our index reporting earnings in the last 3 weeks. So it's a very busy time to update our valuation models and forward outlooks for each individual sectors and each individual company. At the moment, we're looking to remain overweight names that we believe have strong secular demand for their property type, which can help buffer the potential impact from any economic softness that could unfold in the future. So, this secular demand is typically driven by factors such as demographics, where we see an aging baby boomer population in need of senior housing over the coming decade, not just the next few years, or a millennial population that is entering the prime life stage of household formation, but is running up against, unfortunately, housing unaffordability issue in the US. And this currently means a deferral of home ownership in favor of renting for a longer period, which serves to benefit and create that secular demand for single family rentals. We also want to be mindful of not over allocating to subpar balance sheets where debt refinancing costs can be meaningful, as well as keeping an eye on incorporating too much speculative development risk at this point in the commercial real estate cycle, where a downturn in the economy could have pretty profound negative impacts to a company's earning potential going forward for having that speculative development lease up risk on the balance sheet.
Patrick, we've covered lots of ground, but is there anything else that we haven't touched on related to REITs and listed real estate investment today that you'd like to share with listeners?
One thing I always like to point out to investors interested in the listed real estate space is really the diversity by property type that REITs afford today relative to the past. Commonly, when generalist investors think of REITs, their minds think of, let's say, the big four property types, which would be office, retail, industrial, and multifamily apartments, which today still comprises the large majority of private commercial real estate. Now, if you go back to pre the great financial crisis, let's say in 2007, and looked at the REIT index, you'd be right to think of these four property types because they comprise greater than 70% of our index back then. However, today listed real estate and the REITs provide with access to many more alternative property sectors, so much so that currently those same big four property types only comprise slightly more than 1/3 of our index in the US. The remaining 2/3 of the index is comprised of real estate such as data centers, self storage, senior housing, medical office buildings, cell towers, billboards, manufactured housing, and single family rentals, which I mentioned earlier, just to name a few. So many of these property types are quite difficult and arduous and time consuming to gain exposure at scale in via the private market today. But by investing in REITs, you have the opportunity to invest in companies that already have the scale and industry experience within these more specialized asset classes. And many of these specialized asset classes that I mentioned have higher growth and asset appreciation potential as they become more institutionalized. So REITs really have evolved very meaningfully over the last 15 plus years, which is something that I think isn't as well understood by the general investor. So I always like to point that out, that you really are getting more than just that big four that really still comprises the bulk of the private commercial real estate space today.
Excellent. Patrick, thanks so much for joining the podcast today.
Absolutely. Thanks for having me.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.